about financial price charts. They are the beginnings of all kinds of technical analysis. So it's no secret that online trading can be performed more efficiently if you possess the necessary tools. So the perfect place to start is understanding and reading charts. So whether you're performing fundamental, technical, or quantitative analysis, there are many different ways that forex traders predict the movements of assets. Some traders focus on news and interest rates and economic variables, while others prefer to use charting tools and indicators to guide their trading decision. Now, when we talk about technical analysis, it sounds rather big and scary. Okay, but the fact is, technical analysis could be simply called chart analysis. It is anything and everything that you do with a chart. So, however, no matter your trading method, you'll need to know how to read a chart. There's just no escaping it. You must crawl before you walk, and charting is no different. You need to have a good understanding of the basics before you can progress to the advanced stuff. Now, everybody says to me, that's kind of ridiculous. You know, I've read all the stuff about Apple, and Apple's going to go up, so I'm going to buy it whether I'm investing or trading. Okay, you've made a smart decision. You've listened to Steve Jobs, you've listened to Apple, you've listened to all their earnings reports, you've read all the data, and you're completely right in your assessment. But how do you know what price you want to enter the market? How do you know when the market's turning against you? You're only going to be able to see that in a price chart. So in other words, if all the information about Apple came out good, and Apple was trading at, I don't know what Apple's trading for today, but say hypothetically, Apple is trading at 142. How do you know that's a good price for Apple? Maybe the market's already realized or understood or interpreted what this earnings data was going to be or what the speech was going to say, and they've already pushed the price up too high. How do you know this without looking at a chart? So a price chart is simply a graphical depiction of the current and historic price of an asset. It puts price movement in a visual format that our brains can understand. You know that old saying, a picture's worth 1,000 words? Well, this is one of the cases that is very, very true. Now, there are three primary display methods of a chart. We have candlestick charts, and because of online training and the development of computers and all this new stuff that we have with Java charts and HTML, candlestick charts have become the biggest in demand for online trading. It used to be bar charts. Okay, and bar charts is what I learned to trade with 40 years ago, because when I learned to trade, we didn't have computers doing this. We didn't have computerized charts, and we were doing hand charting. And a bar chart and a candlestick chart have the same data, but a candlestick chart takes a lot more time to draw on each time frame. So most people didn't use candlesticks, they used bar charts. But now, because we have computerized charting and nobody charts by hand anymore, the computers can do everything just as fast. So candlestick charts have become the favorite. But then, of course, we have line charts. And a line chart is a very good way to simplify the display of price. Can't trade from a line chart, doesn't give you any information. Because a line chart will show you the closing price for each period. So if you're looking at a 1 hour chart, you simply put a dot on the chart at the end of each 1 hour. And you'd end up with a chart that looks just like what you have on your screen. Okay? It gives you a general understanding of where the market's going, but no information that you could trade from, because it's simply a dot at the close of each period. So right now we're looking at the Euro USD 30-minute chart. That means we're looking at the price chart of the Euro US dollar in a 30-minute time frame. We'll talk about time frames in a little bit. But what that means is every 30 minutes, we're putting something on the chart. And a line chart, we're putting the close on the chart at every 30 minutes. And this is simply a line chart. So a line chart simply draws a line from one closing price to the next. And when strung together with a line, we can see the general price movement of a chart over a period of time. But that's it. Bare basics. From here, we go to my favorite, and that's called a bar chart. And now, again, we're looking at the Euro US dollar 30-minute chart. That means every 30 minutes, one of these bars is put on the chart. But all of a sudden, now this is the exact same time, the exact same period, the exact same everything that we were looking at in the line chart. So can you see the difference between this chart and this chart? We see a lot more detail, and it gives us enough information in an easy to see format that our brains can accept it and see things with it. So each one of these little doohickeys is called a bar. Each one of these gives us 4 pieces of information. It gives us the open, the high, the low, and the close for that period. So this means every 30 minutes, we're putting a line on this chart that gives us the open, the high, the low, and the close for that 30-minute period. And what we can see real quickly is we can now start seeing on here prices that were important. Look at that. We can see some commonality in these prices. We can see how many opens and closes were strategically important. Here we can actually see a beautiful downtrend with all the highs holding right to that downtrend. Okay. We can start seeing information that price is trying to tell us because we're getting a lot more information than we got in the line chart. So each one of these bars gives us the open, the high, the low, and the close. So to put one of those bars on the chart, and we were looking at a 30-minute chart, every 30 minutes we go to the chart and we would put a dash, or I call it a doohickey, to the left for the open. At the close of that 30 minutes, we would put a doohickey to the right. We would go back and we'd put a dot at the highest point it reached in those 30 minutes and a dot at the lowest point it reached those 30 minutes. And we would connect those dots through the doohickeys together. Now, if we stepped up from the open to the close, so imagine this is a ladder, and we climb up the ladder, that is a bullish session. Tells us the bulls were in control and the market's moving in a positive or long or upward direction. The reverse is when the open is higher than the close, or we would have stepped down the ladder. This gives us a bearish session. So now we can start using these bars to start really interpreting some price action, trying to understand who's in control of the markets. Lastly, we come to a candlestick chart. Now, the candlestick chart we're looking at is for the same exact period, 30 minutes, Euro US dollar, same period, same prices. Looks very much like the bar chart, except it's colored in reds and greens. So each one of these, what we call candlesticks, represents the 30-minute period in this chart, because we're using a 30-minute chart. If we were using a 1-hour chart, it would be a candlestick was put on every hour. If we're using a 1-day chart, a candlestick's put on every day. Now, the unfortunate part we have with candlesticks, and it's a problem that novice traders get lost in. Candlesticks are not about the amount of red and green we see. Now, we're human beings, and when we see red, we think down. When we see green, we think up. But candlesticks aren't about the reds and greens. They are about the shape and the size of the candle. Like this candle looks very different than this candle, looks very different than this candle. And so the first thing we have to learn about candlesticks is how to read the shape and the size of the candle. After that, we have to understand the single, two candle, and three candle formations. Most candlesticks are about the current candlestick, the preceding candlestick, and the most recent candlestick. And they have very specific patterns like Hammurabi and Marabuzu and a bearish engulfing and bullish engulfing. So candlesticks can be deceiving unless you understand how to read them. Once you do, and if you put the effort in, they're very, very good. For the life of me, I don't know why so many new traders want to use candlesticks without putting the effort into learning about them. They just want to see the reds and the greens, and the reds and the greens don't help us anything. So it leads them into trouble. So now, although bar charts and line charts were quite popular among Western traders, Japanese candlestick charts and the additional patterns were introduced to the Western world in the 1990s. The popularity of candlestick charts has soared among the Western market analysts over the last decades because of its highly accurate predictive nature. Candlestick charts can play a crucial role in better understanding price action and order flow in the financial markets. Now, each one of these candles gives us the same information. We draw a line across at the open, a line across at the close, put a dot at the high and a dot at the low. We could, instead of putting the line all the way through, we connect the dots to the lines. Then we connect the lines together. And if it was a bullish session, today we'd color it in with green. If it was a bearish session, we would color it in today with red. So in other words, if you step up from the open to the close, just like we were on a bar chart, climb the ladder, that's a bullish candle, and we color it in with green. If we step down the ladder from the open to the close, that's a bearish session. So if you notice, we have the same information. We have the open, the high, the low, and the close in each one of our bar charts or our candlestick charts. They're using the same information, giving them to you in a slightly different picture format. So before you can read a candlestick, you must understand the basic structures of a candle. Each candlestick accounts for a specific time period, and it could be from 1 minute, 60 minutes, daily, weekly. Regardless of the time period, a candlestick represents 4 distinct values on a chart: the open, the high, the low, and the close. So they're all pretty much the same. Although the same 4 values are also found in the bar chart, the bar chart uses horizontal lines on the side of the vertical line to project the open and close. But a series of candlesticks on a chart can help traders, and remember what I just said, a series of candlesticks on a chart can help traders identify the character of price action more definitively, which helps us in our decision-making capacity. So if you see on this chart, we have the exact same information, just displayed in slightly different manners. My favorite, and I'm prejudicial, but I've been using a bar chart for 40 some years. Okay, candlesticks are just fine, but what I'm saying is you have to learn how to use candlesticks properly. So I'm going to pop up a little presentation that'll explain candlesticks more to you, since everybody's more into candlesticks. And then we'll go on talking about time frames and how to set up your charts properly. So as you can see, candlesticks are a little bit more complicated than just a chart. So I popped up on your screen the link if you want to go see that short little presentation. Just use that link and it'll take you directly to playlist and just look for Candlestick Charts and the playlist, and you can see all of our short little videos on candlesticks. I've also didn't mention to you, there are 2 handouts that I prepared for you tonight. And the only way to get these is during the live class. So in order to get these, on your screen, you see the little handout box, and you can see the Introduction to Technical Analysis and Reading Financial Charts handout. You need to download them now because they're not going to be available to you in any other format except tonight's class. Download them to whatever device you're using, and then you can move them around later. But you won't be able to get them in the recorded version of this class. And they'll help you understand charts better and also give you some guide to technical analysis. And before you freak out, one of the main reasons that people or traders want to learn how to read charts is so they can apply technical analysis. Now, technical analysis, like I said before, it could be simply just called chart analysis. It is not about indicators and oscillators, these MACDs and RSIs that people get caught up on. Those are called technical indicators. They are just one small study of the field of technical analysis. Let's pop up some live charts, and I've got some set up for you. And we're going to take a look at why you might want to learn how to read a chart properly. So, first of all, we're looking at the Euro US dollar 30-minute chart and a live chart. And on this chart is in candlesticks. Now, today, like I was mentioning earlier, the reason people use candlesticks is because they're so easy to use now. You don't have to do anything. You don't have to fill anything in. And you can flip back and forth from a candlestick chart to a bar chart in a squint of an eye. So you can go back and forth and use whatever you would prefer or you'd like. Okay. Now, it also did up until very recently, we didn't have red and green bars either. I think they're absolutely terrible because bar charts were meant to be black. But today, because of all this Java and HTML charts and computer programmers and developers, they can make anything and everything happen. So on this chart, it's set up that way, but we can change it and make all the settings whichever way we want. I prefer my bars all black. And so I have a black bar chart. Same thing with candlesticks. Okay. Candlesticks are typically today red and green. Now, I'll give you a little bit of quick history while we're looking at this. A lot of things you'll be reading or looking at over time will be talking about black and white candles. Okay. In the old days, my days of trading, when we did hand charting, the people who drew candlesticks. Now, remember, candlesticks have been around since the 1700s. Okay, it was developed by rice traders in Asia who use this method to forecast the price of rice. So they've been around forever. But when they came to the Western world, and people were hand charting, and that means they were sitting there with a pencil and graph paper, and every price that came up, they were putting on their chart themselves, that they would do all the steps, they opened the high, the low, and the close, but they didn't run around with multicolored pencils. We didn't have magic markers back then. And so what we would do is if it was a negative or a bearish session, you'd use the size of the pencil and color in your candle. And so that would make it a black candle. And when it was a bullish session, you just wouldn't fill in the candle. So that became the white session. So it used to be black and red, black and white. Today it's been replaced by red and green. But the fact is, if you wanted to use chartreuse and turquoise, you can. As long as you know which one's bearish and which one's bullish, you can use whatever color you want to use. Okay. There's no law about reds and greens or blacks and whites. It's just bullish and bearish. Now, one of the reasons we want to learn to use a chart is so that we can put things on, like here, I put my moving averages on a chart. Down below, I put on an indicator called MACD. Okay. But those are only certain reasons. Here we've got a chart set up for Ethereum dollar, and we're looking at chart patterns. And here you see the development in the green lines over here of a chart pattern well known as a triangle. That chart pattern tells you something about the market. In fact, it told us that the price was being forced into this apex here, and as it got closer and closer to the apex, it was going to break out. Okay. We saw that breakout occur just a little while ago, and we can actually judge. There are formulas that would tell us the momentum of the breakout, which is how far up that price should move when it breaks out. So it's really equal to the distance between I forget what side, this third side of the triangle, but we can use this amount to predict when it breaks out how far it can go. We also can put on our charts something simple called volume. Volume is the number of trades taking place. Well, we can see here, we would want to see volume surging when we have the breakout. You can see how volume on our chart surged. That supported the definite breakout. I told you it wasn't a false breakout. We saw volume surge all the way up, and we saw the momentum of this candle, this price movement carry it all the way up. And like I said, we could measure this part of the triangle and then put it on here to project how far the momentum should carry it. Okay, so these are different ways that we would use charts. So here we have chart patterns and we have volume. Here we have indicators and moving averages. And lastly, we have over here another chart set up using strictly candlesticks and lines of support and resistance. Now, you as a trader, I've shown you 3 different charts. You as a trader decide what strategy and what importance you would like to have. No. So here we have what's known as resistance, which comes from historical price. Here we have price support, which also comes from historic price movements looking back at charts. Here we have a stronger support level. So when we see price moving up and down, we would expect it to bounce off of its support levels and move up to its resistance levels, come back to its support levels. Okay. But again, we have whole classes in indicators. We have whole classes in individual indicators. We have classes in chart patterns. We have classes in volume. We have classes in how to understand support and resistance. You're not going to master all this in one quick class tonight. Tonight, we're just talking about why you would want to use your charts, okay, and the different types of charts you want to look at. Now, once you know how to put an asset on a chart and you understand the different kinds of charts, let's get rid of the indicators down here, because down below we have indicators that are dropped below the charts. And then you also have indicators like Bollinger Bands that are put on the charts over top. But these all fall in the field of charting indicators, okay, as opposed to price patterns or chart analysis. But as you notice, it's all done on a chart. So let's get rid of these and get them off the charts. Okay. Now, as we can see on this chart, we're going to go over to my bar chart, only because it's a little bit easier to discuss. Let's make my lines a little bit thicker so that you can see them a little bit better. There we go. Now, as we talked about, whether it's candlesticks or bar chart, each one of these represents a specific time segment. So right now we're looking at the euro US dollar in a 30-minute time segment. That means every 30 minutes, one of these bars are put on a chart. Okay. But this is very good for short-term trading or CFD trading, because it helps us see an entry point and it helps us to see short price movements. But time frames are very important, because if we take the same asset and go back and look at it in a 1 hour time frame, we see a lot different view than what we saw in the 15-minute chart frame. We see we have a beautiful, well-defined uptrend here. Okay. But because it's taking place in a longer time frame and we're a short-term trader, now we would use a longer time frame to define the market and help us decide if we're going to trade in the market. In this case, I would be definitely looking to trade in this market, and I would be looking for a position to enter a long trade or a buy. So I would then move it down to a shorter time frame to help me find my entry point into the marketplace. Now, what happens is the price never changes. We're not altering price. What we're doing is, see right here, these two lines, each one of those is 30 minutes. So those two lines form the 1 hour. But when we put a 1 hour chart in, those two frames are put together, but we can't see the half-hour high and low. We just see the highest point it was in the hour and the lowest point it was in that hour. Okay. Now, it would be very important to us if it was very, traded much lower in that half hour ago and jumped up and was trading higher in this half hour. So when you break down the time frames, you can see more definition about what price is doing. But also by projecting that in longer time frames, like a 1-day chart, we get to see something else. We see right now in a longer time frame over the last few months, the euro isn't trading in an uptrend, which we thought when we looked at the 1 hour and the half hour. The euro is trading in a very slow but well-defined downtrend. So that tells us something else about the market. So we know in a longer term, the euro is trading down, but in a shorter term, it's trading up. So what we actually have is we're in what's called a retracement, because a downtrend or an uptrend either, they go and push and ease, 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 push and ease. The other thing is we have a very, very, very well-defined trend line here. So by pulling this trend line farther, we can then identify where that euro should be easing down to, as well as a well-defined uptrend and where it can bounce up to. So now we have trend lines that are helping us determine price. So if we were to say that 115 is a high price, and the euro is probably going to fall down here to about 112 or 111.90 on the downtrend, we've now put a trend, or we've established somewhat about where the euro should be trading. Now, we wouldn't make a trade based on a 1-day time movement. We want to isolate it into a smaller movement. But now we've got some information, some valuable information that we can use with the price. If we were to move back even longer term and move it to a 1-week chart, we get to see a little bit more. Now, these were the trend lines, but we also see it starting to form into a wedge, or it's actually forming a triangle. So we would expect that triangle to finish its formation and then get a breakout up or down. So we're getting some more valuable information about the price. Okay. But we can see on a monthly chart that the euro is actually recovering and has been moving in an uptrend and is now in maybe a retracement of that very long-term uptrend. So again, we're getting a better definition or better understanding of price by using different time frames. So let's go back over to my PowerPoint. So even though not every trader is using technical analysis, it can be useful. And even if it's not your primary trading method, technical analysis relies on the price that is on the chart you are using. Most charting systems will allow you to add any type of technical analysis tools as overlays onto your chart. Now, always check the time frame displayed, not the time frame where we're using 30 minutes or 1 hour. You want to make sure, first of all, what chart you're looking at. You also want to make sure you have your chart set up in your home time zone, because it'll help you. But many trading systems will use multiple time frames to determine entry points. So a lot of times you'll be reading a strategy and it'll tell you, use a 4-hour chart to determine whether you're going long or short, and use a 30-minute chart to determine what point you want to enter. Also, your indicators like MACD and RSI, they get adjusted by the highs and the lows of the time frame of the chart you're looking at. So to ensure that your chart you're looking at has the correct time frame for your analysis, the best way to do this is to make sure it's to set your chart to the correct time frame and indicators in them for the system you're trading, and save and reuse that layout. Now also realize that the times on the bottom of the chart are set to a particular time zone. Let me pop that up here for you and let me show you. See down, let's go back to a half hour. See on the bottom of the chart, we have 12 noon, we have 1800. Okay, this is where the price is at 1800. This is where the price is at 2000. My charts are set to GMT time. Okay, you need to make sure you set your charts to your local home time zone so you're not miscalculating this. And when you're using it in combination with your trading platform, you're using it in combination with your economics calendar, you're using it in time with news or headlines that you're expecting to come out. You need to make sure they're all synced together at the right time so you don't make a mistake. So anywhere you go, you can just find the settings for your chart and just click over and make sure, oh, see, mine is in the wrong time. I don't want to use. It's because I'm opening and closing charts all the time. We want to make sure it's set for the right time. See how easy it is to mess things up? So we ought to make sure we're using the right time, and we also want to make sure that what time frame we're looking at. Don't make a big mistake and think you're looking at a chart. Okay, see, we have a triangle developing on Ethereum US dollar, but that's only on a 4-hour chart. If we were looking at a 1-hour chart, that triangle wouldn't exist any longer because we'd see something completely different. Actually, that triangle does exist here beautifully. And you can see the momentum and the breakout here. So that's a very nice, but not all of your stuff holds the same in different time frames. So make sure you're looking at the time frame that fits your trading, and make sure your chart is set to your home time zone. Let's go back to my whoops. So make sure you select the time frame for your charts. One of the most important steps in using currency charts or any other kind of financial chart is to set a specific time frame. The values that you view are only relevant to the specific time frame that you establish with them. Charts help traders evaluate market behavior and help them determine where the security will be in the future. To help make sense of the price movement depicted on charts, traders have developed a number of different visual guides to assist them. One of those is called indicators. There are typically hundreds of different types of trading indicators developed to cover every aspect of trading, from trend following to mean revision. Indicators are mathematical formulas. And you know what? All of these indicators, we're talking about RSI, MACD, they go on forever and ever. Stochastics, there's literally more and more coming up every day in the market. But guess what? They're all based on 5 variables: open, high, low, close, and volume. Now, they may calculate them differently. They may apply different formulas to them, but they all use the same 5 pieces of information. So regardless of how you want to trade, what information you want to use, and how much you want to learn, regardless of your strategy, you need to put some basic lines on a chart that will help you understand the markets. So regardless of how you're going to trade, whether you're trading from fundamental analysis, quantitative analysis, whether you're using scanners, robots, there's some basics you got to do with a chart. And that is some basic lines. That is to put your support and resistance and your trend lines on a chart so that you can look at a chart and at least interpret what price action is doing. Not making a decision, just to be able to understand what price action is doing. So every trader should be able to have some basic building blocks: trend lines, support and resistance levels, and volume. Okay. Now, those actually make up a very good trading system, but that's the basics. And we have classes called The Trend is Your Friend. We have support and resistance and volume, and all in separate classes, okay, that you should attend. But you should, no matter how you're going to trade, no matter what you're going to do, you should learn how to put these basic lines on your chart and how to read a basic price chart. Because ultimately, no matter what you're trading, no matter how you trade, the only thing that dictates what's going to happen out there is price action on the chart. That's it. Because the markets can fool you all at once. Indicators can give you bad or false signals. Chart patterns can be completely wrong. The only thing that's always right is price action. It's the only thing that doesn't change. It's the only thing that you have to be able to read. The rest is trying to interpret that price action. So hopefully the handouts I gave you tonight, Introduction to Technical Analysis and Reading Financial Charts, will help you along that route. And if you go to www.tradetime.com and click on their education section, they have all kinds of ebooks, all kinds of videos, all kinds of handouts that will help you learn along the way to become a good, solid trader. So thank you very much for joining us tonight. Remember, you have the link I popped up on your screen before. I'll give it to you once again to see just a short presentation that was incorporated here on Candlesticks. Or you can see a little bit more on technical analysis by going to that YouTube link. You'll be able to see this class by using the same link you used to come to tonight's class. Or down the road, investing.com will have it posted on their website. But in the meantime, download those handouts I gave you, and then go to www.tradetime.com and start your education there. So thank you very much for joining us tonight. Have a great night, and we'll talk to you again real soon. Bye now.